Friday afternoon, while most of the world was already thinking about the weekend, three things happened quietly within hours of each other. The Vice President of the United States canceled a flight to Switzerland. No explanation, no statement, just silence. At the exact same time, Goldman Sachs pulled out a calculator and cut $500 off their own gold target. And while both of those stories were still breaking, silver dropped to $63. Now here's the part nobody is talking about this weekend. These three events are not separate stories. They are one story, told in three different rooms. And by the time you finish watching this, you will understand something that most analysts will not figure out until Tuesday morning. If you are joining us for the first time today, I want to ask you something, not as a YouTuber asking for a favor, but the way a neighbor might ask you for 5 minutes of your time over a cup of tea. Subscribing to this channel costs you nothing, not a single rupee, not a single dollar, but it tells us that you want to keep learning, that you want to be the kind of person who understands what is happening in the world before everyone else does. So if you believe this channel deserves a small place in your daily routine, please subscribe and turn on the bell, so we never lose touch with you. And I am genuinely curious today, where in the world are you watching this from? Write it in the comments below. Let us see how far this conversation travels. Now, let's go back to Friday afternoon and break down exactly what happened. Every Monday morning, the silver market gives a clue about what kind of week is coming. This past Monday, that clue was misleading. Silver opened near $67. Across diplomatic channels, the Iran agreement looked close to finished, close enough that traders treated it as a formality. The mood across precious metals desks was calm. Calm, in this market, usually means confidence. Confidence usually means people are positioned for more of the same. By Friday afternoon, none of that confidence remained. Goldman Sachs had quietly lowered its year-end gold target by $500. Vice President Vance had canceled a scheduled trip to Switzerland, offering no public explanation. And silver, which had opened the week near $67, printed a low of $63. To understand why this matters, it helps to look at what was supposed to happen this week, not what did happen. Three separate developments were expected to support precious metals. A new Federal Reserve chair was expected to bring a more predictable, market-friendly tone. A peace agreement between the United States and Iran was expected to be formally signed, removing geopolitical risk from the table, and falling oil prices, tied to that same peace process, were expected to ease inflation pressure and strengthen the case for future rate cuts. Each of these three forces had one thing in common. Analysts believed they would work in favor of gold and silver. Lower rate cut uncertainty, reduced war risk, and easing inflation are normally the kind of environment that lets precious metals climb steadily without much resistance. Instead, by Friday, all three had reversed. The new Fed chair's first public commentary did not bring the calm that traders expected. It brought something closer to confusion, with internal disagreement among Federal Reserve officials becoming public in a way that rarely happens. The peace signing that was supposed to finalize the Iran agreement did not take place. And falling oil, instead of being read as good news, was interpreted by some traders as a signal that energy markets expected the ceasefire to hold, which, paradoxically, reduced the safe haven appeal of metals. What looked, on Monday, like three tailwinds for silver and gold had become, by Friday, three headwinds. This is the part of the story that most coverage missed this week. Financial media tend to treat each of these events separately. One article about the Fed, one article about Goldman's revised forecast, one short note about Vance's canceled trip. Treated individually, none of them looks especially alarming. A forecast revision happens often. A diplomatic delay happens often. A vice president's schedule changes for all kinds of reasons that have nothing to do with markets. But when three signals point in the same direction within the same 72-hour window, they are no longer separate stories. They become one signal, told through three different channels. That is the lens this breakdown will use. Not three unrelated headlines, but one connected sequence. A monetary signal, a diplomatic signal, and a price signal that together describe something the headlines, read individually, cannot. This matters for a very practical reason. Anyone making decisions based on capital, whether that is a business owner managing reserves, an entrepreneur thinking about how to protect savings, or an investor weighing exposure to metals, is not served well by reacting to single headlines. A single headline about Goldman cutting a forecast can trigger panic. A single headline about silver dropping 8% in a week can trigger the same panic in the opposite direction, a feeling that the opportunity has been missed entirely. Neither reaction reflects what actually happened this week. What actually happened is more specific and more useful to understand. A monetary policy shift altered short-term expectations. A diplomatic process hit a procedural delay, not a collapse. And a price move reflected both of those developments at once, compressed into 5 trading days. The question this breakdown intends to answer is not whether silver is going up or down next week. That question, asked in isolation, leads to the same shallow analysis already filling timelines and comment sections. The real question is this: which of these three forces represents a temporary disruption, and which one represents a structural change that will still matter in 3 months? That distinction is where the next 4 parts of this story will go, starting with the piece of news that almost everyone is reading incorrectly. Goldman did not simply turn bearish on gold. The full note told a very different story than the headline suggested. A single number drove most of Friday's coverage about Goldman Sachs: $500. That was the size of the cut Goldman made to its year-end gold target, moving it down to $4,900 per ounce. For most readers, that number alone was enough to draw a conclusion. Goldman had turned bearish. The bull case for gold was over. Time to move on. That conclusion is incomplete, and understanding why matters more than the headline itself. To see the full picture, it helps to go back to January. That was when Goldman first set its target at $5,400. At the time, gold was trading near its all-time high. Iran and its regional opponents were still actively engaged in conflict. The Federal Reserve was openly projecting multiple rate cuts for the year ahead. Every input that feeds into a gold forecast was pointing in the same direction, and Goldman's number reflected that environment. By this Wednesday, one of those inputs had changed sharply. The Federal Reserve's updated projections, released alongside the new chair's first press conference, showed something rare. 9 of 19 Federal Reserve officials were now projecting a rate hike before the end of the year, not a cut. That is not a minor adjustment. That is close to half the committee reversing direction on the single variable that gold prices respond to most directly. Goldman's $500 cut was a mechanical response to that one data point. It was not a broad reassessment of gold's long-term value. It was a narrow technical adjustment tied specifically to interest rate expectations, the same way a business might revise a sales forecast after a single major client changes their order size without revising its view of the entire market. Here's the detail that almost no coverage carried into the weekend. The same research note that contained the bearish headline also contained a warning, and the warning ran in the opposite direction from how the story was framed. Goldman stated clearly that the $4,900 figure was their base case, meaning the most likely outcome if the Federal Reserve neither cuts rates nor raises them. If an actual rate hike is delivered at some point in 2026, Goldman's own note placed gold closer to $4,400. That is the true bearish scenario, and it was treated by Goldman as a secondary possibility, not the central forecast. The base case of $4,900 sits meaningfully above where gold closed on Friday. In practical terms, Goldman's own analysts are still projecting upside from current levels, even after the headline grabbing cut. The note did not say the structural case for gold was broken. It said the path to higher prices had become less certain in the short term, while remaining intact over the course of the year. There is a second piece of this note that deserves equal attention, because it explains why Goldman did not cut further. The bank explicitly cited central bank buying, running at approximately 50 tons per month, as a structural floor underneath gold prices. This is buying that does not respond to a single Fed press conference. Central banks accumulating reserves are making decisions on a multi-year horizon, tied to currency diversification and long-term reserve strategy, not short-term interest rate signals. Goldman's own analysts treated this buying as the reason a deeper price collapse remains unlikely, even in a less favorable rate environment. Goldman made a second forecast revision the same week that received far less attention but connects directly to the rest of this story. The bank lowered its Brent crude oil forecast, cutting its fourth quarter projection from $90 down to $80, with a lower average projected for the following year. That revision was built on one specific assumption, that Persian Gulf oil exports would return to pre-war levels by the end of July, as part of the broader Iran peace process moving forward on schedule. That assumption is now sitting in an uncomfortable position. The formal signing ceremony that was supposed to convert the preliminary agreement into a binding treaty did not take place this week. Oil markets are aware of that gap, and so is anyone reading Goldman's forecast carefully. What emerges from this is a more precise picture than the one suggested by Friday's headlines. Goldman did not abandon its gold thesis. It adjusted one input, interest rate expectations, while leaving its structural floor, built on central bank demand, fully intact. And its oil forecast, while also revised lower, was built on a diplomatic assumption that has not yet been confirmed. This distinction between a near-term adjustment and a structural reversal is the same distinction that applies to the next part of this story, where the diplomatic process behind that assumption, and the reason it stalled in Switzerland, comes into focus. Every diplomatic process has a moment where intention is supposed to become commitment. For the Iran agreement, that moment was scheduled for Friday, in a resort town in Switzerland called Bergenstock. The Swiss Foreign Ministry had confirmed in writing weeks in advance that representatives from the United States, Iran, Qatar, and Pakistan would gather there to formalize what had so far existed only as a preliminary understanding. Switzerland's public statement described the event plainly. The signing was scheduled, the location was fixed, the date was set. For a process that had moved slowly for months, this looked like the final procedural step. Sign the documents, convert the agreement into something binding, move forward. Then, Thursday night, Vance canceled his flight. No public explanation accompanied the cancellation. The White House offered nothing on the record. For a moment, the story existed only as an absence, a vice president who was supposed to be somewhere and was not. Reporting from international wire services filled in what the official channels would not. Israel had launched new military strikes in Lebanon overnight. Iran, according to that reporting, was unwilling to send its senior delegation by air, while an allied government was under active bombardment. It is a reasonable position to take. Sending top officials into the sky during an active military escalation, even one geographically distant from the signing location, carries a level of risk that most governments are unwilling to accept on a fixed schedule. By Friday morning, Switzerland issued a second statement, shorter and more direct than the first. The talks had been postponed. Switzerland remained ready to facilitate them whenever they could resume. No new date was given, no timeline was offered, no further explanation followed. This is the detail that matters most for anyone trying to understand what happened to silver this week, and it requires a distinction that financial headlines rarely make. There's a meaningful difference between a political memorandum of understanding and a formally ratified treaty. The agreement that already exists between the parties involved is the former. Both sides still acknowledge it. Neither side has withdrawn from it, but it lacks the binding implementation mechanisms that only a formal signing produces. Specific timelines for reopening shipping routes through the Strait of Hormuz, a defined schedule for lifting oil sanctions, and a structured framework guiding the 60-day negotiation period that was meant to follow. None of that conversion took place this week. The understanding remains an understanding. It has not become an enforceable commitment. This gap between a political agreement and a binding one is precisely the space where markets price risk most aggressively. A signed treaty tells every participant, from oil traders to metals investors, that the terms are locked in, that backing out carries real diplomatic and legal cost. An unsigned understanding tells those same participants that the situation can still shift, that a single military strike in a neighboring country can delay the entire process indefinitely, with no rescheduled date offered. Silver's move this week reflects that exact uncertainty. The intraday low of $63 and a Friday close near $65 represents a market recalibrating around a simple, uncomfortable fact. The war premium that had built into silver prices since February has not been fully resolved, and the event that was supposed to resolve it did not happen on schedule. It would be a mistake, however, to read this as confirmation that the entire peace process has collapsed. Postponement and collapse are different outcomes, and so far, only the first one has occurred. Switzerland's continued willingness to host the talks and the absence of any formal withdrawal from either side suggests this is a delay caused by an external military event, not a fundamental breakdown in negotiations. What this delay does confirm is something more specific and more useful for anyone trying to understand silver's price action. Geopolitical risk did not disappear this week. It simply moved from a state of near resolution to a state of indefinite pause, and the silver market priced that pause in real time. That pricing, though, only explains part of this week's move. Underneath the geopolitical story sits a second, entirely separate force. One that has nothing to do with Switzerland, Vance, or treaty timelines, and everything to do with what is sitting inside a vault in New York. That is where this breakdown turns next. While headlines this week focused on diplomacy and Federal Reserve projections, a quieter set of numbers was building inside the KOMX exchange in New York. Numbers that matter regardless of what happens in Switzerland or at the next Fed meeting. As of Friday's close, registered silver sitting inside KOMX warehouses stood at 86.2 million troy ounces. Registered inventory means metal that is physically available and legally committed for delivery, not silver that exists only on paper or in unallocated accounts elsewhere. Against that 86.2 million ounces, the July 2026 futures contract still had 40,180 contracts open, each representing 5,000 ounces. That works out to roughly 201.9 million ounces of paper claims tied to that single contract month. Claims that carry a legal right to demand physical metal. Measured against the available vault, that means paper contracts outweigh physical silver by more than 2 to 1 on the July contract alone. Measured across all open contract months, the imbalance is wider still, with paper claims running at more than 6 times the registered physical supply. This imbalance becomes important because of a date already on the calendar. First notice day for the July contract, the point at which holders must formally declare their intention to stand for physical delivery, falls just a few business days from this Saturday. Every session between now and then either adds to or draws down that 86.2 million ounce figure, and the direction it moves will say a great deal about how tight this delivery window becomes. This is not the first time the market has approached a moment like this. Earlier this year, in February, COMEX registered inventory fell below 100 million ounces for the first time in the exchange's history. That single threshold being crossed triggered a wave of contract holders choosing to stand for physical delivery rather than accept cash settlement out of concern that the metal itself might become harder to obtain later. The result was the highest physical delivery volume recorded in modern COMEX history, with more than 52 million ounces standing for delivery in a single month. The vault today, at 86.2 million ounces, sits roughly 14% below the level that triggered that earlier surge. That comparison does not guarantee a repeat. It does establish that the exchange is operating closer to a historically sensitive threshold than it was even a few months ago. Layered on top of this is a data calendar that gives the coming week real weight of its own. Tuesday brings flash readings on manufacturing and services activity. Thursday is the busiest single day, bringing a final revision to first quarter GDP, a fresh durable goods orders report, weekly jobless claims, and the personal consumption expenditures report, which the Federal Reserve treats as its preferred measure of inflation. Friday closes the week with revised consumer sentiment data. Among all of these, the Thursday inflation report carries the most weight for anyone tracking precious metals. If that report shows inflation cooling from its most recent reading, the case for a Fed rate hike weakens, and pressure on metals eases with it. If it comes in hotter than expected, the probability of a hike before year-end strengthens further, and the $63 level silver touched on Friday becomes a level worth watching closely again. None of these numbers, the vault total, the leverage ratio, the data calendar, depend on what happens in Bergenstock. They form a separate mechanical layer of risk sitting beneath the geopolitical story, one that operates on its own calendar and its own thresholds, regardless of what any government decides to sign or postpone next.